The Social Security Administration does not treat everyone the same. That is not an opinion, and it is not a complaint. It is the actual policy written into federal law. And what that means in real terms is that the rules controlling your monthly check, your full retirement age, your legal claiming options, and the financial mistakes that can permanently reduce your payment for the rest of your life are completely, fundamentally different depending on the single year you were born. Not slightly different, not a minor technicality, meaningfully, significantly, and in some cases, devastatingly different. And right now in 2026, there are people inside every group I'm going to talk about today who are either receiving less money each month than they are legally entitled to receive, or who are standing at the exact edge of making a permanent financial decision without the specific information they need to make it correctly. The reason that keeps happening is not because people aren't paying attention. It is because nobody ever sat down and explained the rules that apply to their specific birth year. Not the general overview, not the average American scenario, the exact rules for their exact situation. That is what this video is going to do. I'm going to walk through 3 distinct groups based on birth year, and I need you to do one thing. Find the group that applies to you and listen specifically to what I say about that group. Because what I tell one group may not apply to yours at all. And what I tell your group may genuinely be the most financially important information you encounter this entire year. By the time this video ends, you will know exactly what to check, exactly what questions to ask, and exactly what steps to take before a deadline closes or a mistake gets locked in permanently. Before we get into the groups, if you are not already subscribed to this channel, I want you to take a moment to do that right now and turn on the notification bell. Here is why that actually matters and why I come back to it every time. The rules governing Social Security change on a regular basis. Claiming thresholds change, earnings limits change, Medicare premium calculations change, overpayment recovery policies change. And when those changes happen, the Social Security Administration does not mail you a personalized letter explaining what the change means for your specific benefit. They update a page on their website that the overwhelming majority of Americans will never visit, and the system simply operates as if you already knew. Every burden of staying current falls entirely on you. And for most people, that is not a realistic expectation, given how layered and technical this system genuinely is. What I do on this channel is translate those rule changes into plain language and real dollar figures for your actual situation. And I deliver that information before deadlines have passed and before decisions are already made. The people who are subscribed and have notifications on find out in time to act. The ones who are not tend to find out after the wrong filing decision, after the window has closed, after the money is already gone. So hit subscribe, turn on the bell, and let's get into the groups. Group 1 covers everyone born between 1943 and 1959. If that is your birth year, you are somewhere between 67 and 83 years old today. You have been on Social Security for some time. Your full retirement age has already passed. And for most people in this group, there is a settled assumption that the decisions are behind them. The benefit is set, and there is nothing left to examine or optimize. That assumption is costing some of you real money every single month, and I want to be direct about exactly where that money is going. The first thing every person in this group needs to examine, and I mean everyone who has lost a spouse, is whether they are currently receiving the correct benefit. This sounds like a simple question, but the answer is not always obvious, and the financial difference is often enormous. A significant number of widows and widowers in this age range are collecting their own retirement benefit when they would receive substantially more money by switching to their late spouse's record. And an equally significant number are doing the exact reverse, sitting on a survivor benefit when their own record would actually pay more. The survivor benefit available to a widow or widower can be as high as 100% of what the deceased spouse was receiving at the time of their death. In many households, particularly those where one spouse had significantly higher lifetime earnings, that figure is considerably larger than what the surviving spouse receives on their own record. We are talking about differences of $300, $400, sometimes $500 or more per month, every single month, for the rest of your life. The Social Security Administration will not call you to volunteer this comparison. They will not pull both numbers side by side and tell you which one is higher. That is not how the system works. You have to ask. Call SSA at 1-800-772-1213. Tell them you want both benefit figures polled and compared directly, and then make your decision based on the actual numbers. If you lost a spouse and have never had that specific conversation, there is a genuine chance you have been leaving money on the table for years. That phone call is worth making this week. The second issue for this group involves Medicare, and specifically a surcharge most people in this range are either paying without understanding why or don't realize they may be able to reduce. It is called the IRMAA, which stands for Income-Related Monthly Adjustment Amount. In plain language, it means that Medicare uses your income from 2 years ago to determine how much you pay for Part B coverage. If that income was above a certain threshold, Medicare adds a surcharge on top of the standard premium every month. In 2026, those surcharges range from an additional $70 per month at the lower tier to nearly $500 per month at the highest tier. That is potentially $6,000 per year in additional premiums that many people are paying without fully understanding the reason. The piece that consistently catches people off guard is the 2-year look-back. That means Medicare may be charging you based on a year when something financially unusual happened. A property sale, a Roth conversion, a one-time distribution from a retirement account, an inheritance. Any of those events can push your income into a higher bracket for a single year. And 2 years later, Medicare is still billing you the elevated premium, even though your income has since returned to its normal level. There is a formal process to appeal this, and most people in this situation do not know it exists. The form is called the SSA 44, and it was specifically designed for people whose income has dropped due to what the SSA defines as a life-changing event, including retirement, the death of a spouse, divorce, and loss of pension income. If you are currently paying above the standard Part B premium and your current income is lower than the figure Medicare is using to calculate your surcharge, this appeal process exists for exactly your situation. You file it with documentation of your current income, and if approved, your premium adjusts accordingly. If you are paying more than $185 per month for Medicare Part B right now, and you have never asked why, that is your immediate next step. Now, I want to spend specific time on people born between 1955 and 1959, because this subgroup inside Group 1 is at a particularly consequential crossroads right now in 2026. If you were born in those 5 years, you are somewhere between 67 and 71 years old, and the single most important piece of information you need, the one that a surprising number of people in this range do not actually have, is your exact full retirement age down to the month, not the general answer, your specific number. Because for every birth year in this 5-year window, the full retirement age is different. Born in 1955, your full retirement age is 66 and 2 months. Born in 1956, it is 66 and 4 months. Born in 1957, it is 66 and 6 months. Born in 1958, it is 66 and 8 months. And born in 1959, your full retirement age is 66 and 10 months. That is your number. Write it down right now if you have not already, because every claiming decision you have made or are making orbits around that exact date. The penalty for claiming before your specific full retirement age is not temporary. Every month you claimed early, your benefit was reduced by a fraction of a percent, and that reduced amount became your permanent baseline. On a $2,000 monthly benefit, claiming 60 months early produces a reduction of over $500 per month, every month, for the rest of your life. The SSA does not reverse this once you reach a certain age. Whatever reduced figure you locked in at the time of your claim is the number you carry permanently. And if you are in this group and have not yet claimed, waiting past your full retirement age continues to build your benefit at approximately 8% per year up to age 70. Which on a $2,000 base can add $480 to $640 more per month for life. That is a calculation worth sitting with carefully before you file. Group 2 covers everyone born between 1960 and 1965. If that is your birth year, you are somewhere between 61 and 66 years old today. For everyone in this group, the full retirement age is exactly 67. No months, no fractions, just 67. And right now, the most important thing for people in this group is building a clear and honest picture of what happens to your monthly check if you decide to claim before reaching that age. The number that matters most is this. Claiming at 62 with a full retirement age of 67 permanently reduces your monthly benefit by 30%. That is not a rough estimate. That is the exact figure, and it does not go away. On a monthly benefit of $2,000, that is $600 less every single month for the rest of your life. Over 20 years of retirement, that cumulative difference compared to waiting until 67 is $144,000. That is not a technicality. That is a significant portion of your retirement income, and the decision to claim early cannot be reversed once it is processed. The SSA will ask you to confirm that you understand your benefit will be reduced. You will confirm. The reduced amount becomes your permanent baseline, and there is no reconsideration window after your first payment arrives. Early claiming is not always the wrong choice. There are health circumstances, financial pressures, and specific household situations where it makes real sense. What I am saying is that this decision needs to be made with complete awareness of its permanent cost in actual dollars, not as a reflexive response to reaching 62 and realizing the option is available. There is also a claiming option available to people in this group who are already past 67 and have not yet filed. If you apply after reaching your full retirement age, you can request up to 6 months of retroactive payments. The SSA pays a lump sum as if you had applied up to 6 months earlier than you actually did. On a $2,000 monthly benefit, that is a lump sum of up to $12,000 delivered with your first check. The trade-off is a slightly lower ongoing monthly benefit since your effective start date moves back. But the option is legitimate, it is underused, and almost nobody in this situation knows to ask for it. Group 3 covers everyone born in 1966 or later. If that is your birth year, you are 60 years old or younger today. You are not close to claiming, and retirement in the Social Security sense is probably not something you are actively planning around. That is exactly why what comes next matters so much. The window to correct certain things at no cost is still wide open right now, and it will not stay open indefinitely. Your full retirement age is 67. Claiming at 62 means a permanent 30% reduction. Waiting until 70 means accumulating up to 24% more than your full retirement age benefit permanently. Those structural numbers are fixed. What is not fixed, what is still entirely within your ability to affect, is whether your earnings record is accurate. The SSA has been recording your payroll data since the first job you ever held. Every year, your employer submitted payroll reports that included your earnings, and that data became your earnings record, which is what the SSA will use to calculate your monthly benefit when you eventually claim. The higher your recorded lifetime earnings, the higher your benefit. The lower your recorded earnings, the lower your benefit. And here is the problem. Every step in that recording chain was performed by human beings using systems that were far less automated in the 1980s and 1990s than they are today. An employer who submitted a slightly incorrect figure, a year that got missed entirely, a period of self-employment that did not get reported correctly, a clerical error that nobody caught because nobody checked. Each of those errors left uncorrected reduces your monthly benefit by approximately $100 per missed or incorrect year. 2 or 3 incorrect years means a monthly benefit that is $200 to $300 lower than it should be every month for the rest of your retirement. The fix is straightforward. Go to ssa.gov, create a My Social Security account if you do not have one, open your statement, and go through the earnings listed for every year you worked. Compare them against your W-2 forms, old tax returns, or any pay documentation you still have. If the numbers do not match, you file a correction request with supporting documentation, and the SSA updates your record. The reason I am telling Group 3 about this now, years or even decades before you plan to claim, is that the documentation needed to prove those corrections becomes harder to find with every passing year. W-2 forms from the 1990s sitting in a filing cabinet right now may not be there in 15 years. Former employers whose payroll records could confirm your earnings may not exist as businesses by the time you actually need them. The window is open right now. It will not stay open forever. Every year of your earnings record that you correct today pays you back in higher monthly income for the rest of your retirement, permanently, at zero cost to you today. So here is the complete picture organized by group so you can take exactly what applies to your situation. If you were born between 1943 and 1959, check whether you are collecting the correct benefit record, especially if you lost a spouse, and find out whether you are being overcharged on Medicare through an IRMAA surcharge based on an income year that no longer reflects your current financial reality. The SSA 44 appeal form addresses the second, and a call to SSA at 1-800-772-1213 addresses the first. If you were born between 1960 and 1965, understand in real dollar terms what a 30% permanent reduction means for your specific monthly benefit before you make any claiming decision at 62. And ask about the retroactive lump sum option if you are already past 67 and have not yet filed. If you were born in 1966 or later, go to ssa.gov today, open your Social Security statement, and verify your earnings record year by year while you still have the documentation to correct errors, and while the correction is completely free. Subscribe to this channel so you hear about the next rule change before it becomes a problem, and share this video with someone you know who falls into one of these groups, because the odds are strong that someone you care about is carrying a correctable mistake right now that nobody has ever explained how to fix.